Okay, this morning all, yeah, as mentioned a few minutes ago, Brad Ashton, Ashton Mortgage Solutions. I live in Hutton near Brentwood, and father of two, and so I advertise under my name, Ashton Mortgage Solutions, but I work with a company based in Basildon, EOL Wealth Management. And the main reason I wanted to promote myself under my name, so I just wanted the word mortgage in there. Go to networking, you've got wealth management in your title, people think shares, pensions, whatever. Don't necessarily think mortgages. So that's why I promote myself under my name, but I work with EOL Wealth Management. So yeah, mortgages been in the news quite a bit recently. Obviously, people are waiting to see how the stamp duty deadline evolves. As it stands, the stamp duty holiday ends at the end of next month. The fear is there'll be a big cliff edge of cases collapsing because cases that won't get done by the end of next month, buyers are going to potentially pull out, saying, well, I don't actually want to pay that extra £10,000, £15,000 in stamp duty, and it could lead to a lot of cases coming crashing down. So we are waiting to see what the Chancellor decides. The industry keeps pushing for a 6-month extension. It seems like Rishi Sunak's got no real appetite for that. We might get 6 weeks, but who knows? Who knows? We have to wait and see. So, but from my perspective, as I mentioned in my 1-minute speech, most of my clients are self-employed, and when you're self-employed, it's not as straightforward as producing 3 pay slips, 3 bank statements, your P60, and showing what you earn. So I attempt to do a bit of screen sharing. Bear with me. Okay, so hopefully this is now working. Like I say, when you're self-employed, really the key is it's not about knowing you can afford the mortgage. It's more about you showing you can afford the mortgage. To the underwriters, you're just a name on a screen or a piece of paper. They don't know you. So it's up to you to document and show that you can afford the mortgage, not just now, but in 2, 5, 10, 15 years' time as time goes on. So the key bits of paperwork they're going to want to see from anyone is your tax computations or your SA 302s, which will show what you've earned in that financial year. Your tax year overviews, because they want to see that you're actually paying the tax on the money you do earn, and your limited company accounts to see how your company's faring. So it's not rocket science. They're the key bits of paperwork they're going to base their judgment on. Now, there's a whole range of lenders out there. As I touched on, I'm a whole of market broker, but you'll all know the high street lenders, Santander, NatWest, Barclays, Halifax, all big names. There's several others I could have put on there. Just to highlight actually the difference at the moment though between the employed and the self-employed sectors. All of those lenders, if you're an employed person on PAYE, they would all consider you for a 90% loan at the moment. But in the case of Santander, when it comes to the self-employed, at this moment in time, they're only going up to 60% loan to value, which is a massive difference, and just shows the sort of caution that some companies are showing given the state of the economy as we try to come out of lockdown, etc. So after a really tough year. But the high street's only one segment of the mortgage industry. There are loads of specialist lenders. Some of these you may know, you may not. Aldermore, Principality, obviously based in Wales. Accord, actually a very good one. They're actually not much more expensive than the high street, but they only operate via intermediaries like myself, so you won't see any branches. They're pretty decent. Kent Reliance are good for shared ownership. Pepper Money, if you've got a bit of adverse credit in your background, they can be one you can sort of turn to. Bluestone are probably the highest interest rate lender I deal with. But again, people who've had problems in the past that have hit their credit record. Credit issues can happen for a whole variety of reasons. Doesn't necessarily make you out to be a bad person, but if you step back on the ladder, they can be a good starting point. I recently had a guy actually on his credit report. He had 13 defaults on his credit record of late, but he still would have fitted with Bluestone because of the dates of the defaults, the size of some of the defaults. You start crossing some of them out. He would have fitted, and the only reason I couldn't get him the mortgage was because he was buying with his girlfriend, and she was only 18. And unlike most lenders, Bluestone's minimum age is 21, so that scuppered that. So it was nothing to do with defaults in the end. It was purely his girlfriend was too young. So that scuppered that. The plan would always be, if you've had problems and you're looking to get sorted again. If you go with Bluestone on a 2-year fix, in 2 years' time, your credit report score will naturally improve. So we can move you to a slightly better lender, another 2 years there, provided you stay on top of things. The score naturally improves over time if you're on top of things. And then maybe after 2 years with perhaps Pepper, we can then get you on the high street. So there's always a pathway for trying to get you towards the best deals if you don't fit straight away. And I just wanted to mention Kensington really, because when it comes to self-employed people, most lenders are going to want to see 2 years accounts. 1 or 2 still want 3, but that is very rare. However, Kensington are one of the lenders who would work with you off of 1 year's books. So you don't necessarily have to wait to complete the second year. Once you've got your first full set of accounts, Kensington would generally look at you. So that can be very useful, again, with the self-employed sector. But like I say, this is just some names I've picked out. There's plenty of others, and there's honestly dozens and dozens of lenders out there. So I've touched on credit scores and credit ratings. To be honest, it's a real pain in the backside. It's something that bugbear of mine, but there are simple things you can do just to make sure that you don't unnecessarily dent your score. So it's not rocket science. It's stay on top of your credit card repayments, your loan repayments. For heaven's sake, on your credit card, set up your direct debit, because if you forget to pay 1 month, you might not pay out as much as you want, but at least the minimum is going out and you're not getting a dent on your credit record. So that's that. Don't use a credit card to take out cash at a cash point. It just suggests you're struggling a bit. Again, payday loans are a big no-no with the high street lenders. They don't like that at all. Even some of the adverse lenders, anything within the past year, payday loan, they'll steer clear of you. And obviously, we've just been through COVID. It's been a strange year. There's been lots of grants available. Now, not everyone's taken grants that they actually need. I've got one client who runs a very successful company, but unfortunately, his application recently got scuppered because in October he had taken out a grant. He didn't really need to do it. So, it can backfire a bit, because the idea is the grant's there to help you if your company's struggling a bit. And some people are just taking it because seeing it's free money. So that can backfire. With the mortgage holidays, I wouldn't say you're actually being punished for taking a mortgage holiday, but I just wanted to mention that if you're on a mortgage holiday, you won't be able to change your deal until you're back to your regular repayments. And if you have taken one, just expect to be asked why you took it. Again, underwriters just being cautious given the state of the past year. So they're just sort of covering their own backs as well, in case there's any underlying reason why all of a sudden you just couldn't afford your bills. So that's that. And then how much money can I borrow? That's obviously another big question that everyone wants to know when they're looking to buy a house, move a house, whatever. So here's a little case study for you. The 3 ways in which you'll be assessed really are, obviously, if you're a sole trader, it's your net profit that's going to count. If you're a limited company director, you're going to be judged either by your director's salary plus your dividends, or your director's salary plus your company's net profits. Now that can have benefits, because you don't necessarily have to take out your profits and pay tax on what you've drawn out. You can just evidence the money's there and you're leaving in the business. That can still help you towards getting a good mortgage deal. So just to show the difference that could make, here's a little case study where, 2019, company 90,000 turnover, director pays himself 10,000 salary, so 48,000 of profit. He takes a dividend of 40,000. Following year, turnover's up, still pays the same salary, but profits are up to 60. He takes a dividend of 50. So they're the figures we're working to. We generally say 4.5 times your income is the multiple most lenders will work to. So in this situation, for those lenders that will average over your, so I should have said, the 3 groups will be, they'll either average the last 2 years. If your trend is going upwards with your figures, some lenders will work to your latest years, which can be beneficial and boost your figure. And as I touched on, as long as you've got net profits, again, lenders will work to the latest years, provided it's better than the previous year. If it's falling profits, then obviously you're shot in the foot anyway, because it's a lower figure. So in this situation, the lenders that average over the last 2 years, you could potentially get a mortgage of just under £250,000, all being well. For the lenders that will work to the latest year's figures, because in this situation, turnover's up, profits are up, so he's paid himself a bigger dividend, so you've got slightly more to play with. You can get another 10% roughly on top. But then for the handful of lenders that will work off your salary and your net profits, all of a sudden you're working to your 10,000, but plus your 60 rather than a 50 or an average. And all of a sudden you could be borrowing over 300,000. So it's almost another third on top of the first figure. So it just sort of goes to show that different approaches can lead to quite different results in terms of your maximum borrowing. So I hope it's been of some interest to you. Gives you a little insight of what I work with. Obviously, happy to take any questions, but otherwise, thanks for listening.
Thanks, Brad. Yeah, that's very interesting. So there's a huge variation there that you've got in terms of what money a self-employed person can get. That's quite amazing, really.
Yeah. And again, it just obviously there's far more to which lender you can fit with than just your dividends and your net profits. I mean, but however, on the face of it, with self-employed, I mean, Coventry Building Society is one where they're very good. They offer excellent rates. They will work to your latest year's salary and net profits, and that's an ideal place to put a self-employed person, really. But that's if we can get you in there. But again, there's lots of factors that come into it, obviously, other than just that. But it's a very useful tool, and it does also has tax benefits because you haven't got to draw down all the money and take it as a dividend and pay tax on your dividends. So you can leave it in the company, and it can be very useful.
Excellent. Any more questions for Brad?
Hi, Karen.
Karen.
Sorry, this is probably a really stupid question.
No, not at all.
I take it with the fact that COVID's going to affect a lot of businesses, that the mortgage they're going to look at the most recent year. Are they going to make any sort of consolations for the fact that it's been a naff year? I'm assuming not, but
no, I don't necessarily think they will. I mean, normally when you get your figures, your figures are valid for 18 months in the lender's eyes. So if you get your accounts last April, in theory, you've got until October this year for them to still count. Now, obviously, just been through a year we've not had for, probably ever before. So it's going to be interesting to see how they play it. But I think the underwriters are quite realistic. I mean, if you work in retail and all of a sudden, with the way the vaccinations are going, they're going to know that you've had a year where you've hardly been able to open, but restrictions are being lifted. We're all getting vaccinated, and the future looks a lot brighter. So they obviously realise that the next year it should be far, far better than the year we've just had. But it's really going to be a case-by-case basis, really. Unfortunately, no one's come out and said, right, we're going to definitely be more lenient next year. Just don't think that. I think, unfortunately, they're waiting to see, because when all the tax returns have just come in, or the accounts have been done this year, that's when we're going to really see how badly some people have been hit, aren't we? So
we're kind of 10 months behind, aren't we? By the time
that's the thing, isn't it? You're always working with old figures, aren't you? That's the trouble. So it always gives a bit of a misleading picture. Unfortunately, a bit of a wait and see on that one.
Yeah, because I have quite a few clients that are self-employed, and obviously we're looking at what they can afford and whatever. So it's interesting.
Yeah, that's right.
Yeah, Brad, I was just going to say, thank you for the very good presentation. And like Karen was saying, I work with a number of self-employed clients, and having an overview for how, you could pull together a mortgage offer based on their income and so on is really useful. So thank you.
Yeah, good. No, thanks, Paul. Appreciate that. Eric?
You're still on mute, Eric.
Some years ago, I was taught that using a credit card is a good thing, even if you don't need the money. Go to the cash point on a night out, take money out, because it shows that you're using a credit card and you can afford to pay it back.
Yeah.
But it's the cash thing which concerns me. Is there a top? Well, this was years and years ago. I've actually used to draw all my cash out from the cash machine using a credit card, because that's what I was taught to do, because it shows you're using it. Now, how long does that last on your credit score? Can they go back 5 years and say, oh, look, this guy was
Yeah.
using the credit
Yeah,
card.
your credit report will have your info for the last 6 years on it. Now, I'll tell you, I hate the whole credit score thing, because if I was looking for a loan and I was just hunting around to see what the best rate I could do, and I was making lots of little applications or inquiries, that would be flagged up as a negative sign, even though in actual fact, all I'm trying to do is get myself the best deal. So I've always personally got a bit of a bugbear with credit scores. With your credit card scenario, you're right. It's good to have a credit card, because there are lots of people out there who've got a very poor, if you like, not bad, but a sort of very average credit score, purely because they don't have any credit, and that can count against them. But what a lender wants to see is you're somebody who can be relied on with credit, so you can borrow money and repay it. You've got a track record of that, so you're a good person to deal with. But I think nowadays, I don't know how long ago you talked about when you said drawing the cash out of the cash point. Nowadays, that's just one little area where people just think it looks like you've run out of money. Oh, I've got to rely on my credit card. So it just counts as a very small black mark. I mean, it's not a deal breaker, that in particular. It's just a little unnecessary dent on your record. But no, you certainly, to have credit is good, because that's how you build your score and just show you're reliable. If they lend you money, you're going to repay it. So, and generally speaking, even with some of the adverse lenders, they like you really to have the last 6 months clear. So Pepper Money, I mentioned, they can accept a lot of issues, but the last 6 months has got to be clear before you go into it. You've all got different quirks. I mean, I'm dealing with a woman who at the moment who's got a bankruptcy on her record, that hasn't quite come off of her record. It was 5 years ago. There are lenders who, if a bankruptcy or an IBA or something is 3 years old, they'll still work with you. There's so many different lenders out there. They're all set up to help if they can. So obviously you've got to expect to pay a higher rate, because they're taking on a bit more risk. But the credit thing though is it's one that irritates me. And the other thing from my point of view is, if you was my customer and I turn around to you and say, "Oh, you failed on credit score," and your next question is bound to be, "Oh, why is that? What was it?" And because of GDPR, no one can tell me. So the lender can't tell me. If you get the right person on the end of the phone, you can have a coded conversation, so you can sort of between you and get a good picture of where it is. But sometimes, honestly, I look at reports, I can't see anything wrong with it, and then, "Oh, sorry, no, I can't tell you. No, it's all data protection." And so that side of it is another thing that drives me nuts.
Thanks, Brett.
Okay.
Go for it, Ian.
That's what it is.
First of all, I'm going to give Brad a testimonial, because he sorted our mortgage out April last year. It came through in the end, but the whole world had gone home for a while, so it took a little bit of doing. But he's fixed us up with a 1.53% rate fixed over 5 years, so we're pretty happy with that. And he did all the shouting and stuff, which was lovely. Which saved us nearly 400 quid a month, so that was quite a big deal for us. But secondly, can you send me the presentation, please, so I can use it?
Yeah, definitely, yeah.
Cool.
Yeah.
Thank you.
I was actually going to say the same, Brad. I mean, I know you and Gavin know each other quite well, and I've met a couple of times, but I'd love to have that slide available, so that when I'm talking to clients, it's something that I can talk about as well.
Okay, yeah, no problem. I'll send it. I mean, I'm glad you like it. I mean, it's the first time I've ever done PowerPoint, so I was.
No. It was.
I thought it was a bit basic.
No. It was just the information that you had on it was it's useful. It's very useful. So
right.
Yeah.
I'll send it to both. That's fine.
That'd be lovely. Thank you, mate.